Okay, good morning, everyone, and happy Friday. I hope everyone is staying safe and doing well. We've had a pretty incredible couple of days here. We've had markets rally about 20% from the lows. So we want to keep everyone updated. For those of you that joined me last night, we did cover some of this stuff with Michael Coe. But today I want to keep you abreast on some of the research that we're currently looking at, especially for those of you that were not able to join us last night, and go over some of the research and some of the positive things that we're looking at. Net, one of the biggest things I think that's changed since we spoke on Tuesday is just the fact that we have far fewer unknowns. We have really only one or two big unknowns left in the market right now. Global central banks around the world, global governments around the world have really stepped up this week with respect to fiscal policy. I think a lot of governments were a little slow on that, but we saw a large number of countries come out with fiscal policies. Japan, which is probably the only one that's still kind of behind the curve, but Singapore, India, European countries around the world coming out with stimulus. And I think that's really what's drove a lot of the market rallies we've seen, the slight stability that we're starting to see in the markets, the return of some liquidity. So we're going to go over all of these indicators that we're currently watching here today. So I think I want to start off by just talking about where we are today and trying to help answer the question that I think is on everyone's mind, which is, what is our directional view, and have we seen a market bottom, or is this just another bear market rally? We're going to see another wave of selling. So just to put into context, we've had about a 35% decline in the markets from 339 down to about 218. We've retraced about a third of that to about 250. We closed at 261 yesterday. We're about to open up a little bit lower here at 253. Normally, a pre-market down 3% would be a huge move to the downside, but after a 20% move in just 2 days, I think a 3% decline pre-market is probably normal. And we are currently in a new normal right now. 3% moves in the pre-markets is probably relatively small compared to the 7-8% we've seen many times over the last few weeks. So from the levels that I'm paying attention to right now, are the major level that I'm really watching here is the 272 level. This is a level that we reached here back in after the strong rally we had in December 2018 off the 2018 lows. We tested 273 multiple times before bouncing off, and that's the major level that I see we need to get back above in order for this to go back to a kind of bull market, if you will. That also puts the that's roughly also a 20% decline from the peak. So those are the levels that I'm really paying attention to. I believe that, there are a lot of investors that are trapped up here, both from within 2019, but also just as the market sold off, we saw a lot of investors continue to try to buy stocks that are trapped up here. And as soon as we try to get back up to those levels, we're likely going to see a lot of selling. So, I think likely what we're going to see is something along the lines of a little bit of a check back because we've had a 20% rally. We might make it all the way back up to that 273 level, but I expect that we're likely probably going to have more of a sideways market in this particular case. That's my view at the moment. As I've said over the last few weeks, every time we do these morning calls, things trade very drastically. So what I'm viewing today may be vastly different by the time we revisit this on Tuesday. Certainly news will come out. So let's go back to some of the indicators that we're currently paying attention to. The big thing that's changed since Tuesday is really the stimulus package, $2 trillion that was just announced yesterday that is pretty much likely going to get passed. That's about 9.3% of our GDP, a significant boost versus the 2009 stimulus package. What is different, as Michael Coe pointed out last night, is that we are ahead of the curve this time. We had monetary and fiscal policy launch before we actually headed into a recession. We know we're going to be in a recession, and some of the numbers that we're looking at is fairly bleak. But we do, because of the fact that monetary and fiscal policy has stepped in so quickly, we do at this point, provided that we can apply the trends out of Italy and China to us, that we were likely going to come out of this recession also in a fairly quick, as quickly as we stepped into this recession, we might be able to step out. So those are the numbers that we're currently looking at just to put into perspective kind of the damage that has been done, it is, I've never seen a chart like this from an economic numbers perspective. It just never works this way. This truly is what we would call a black swan event. And I remember even doing an event about a month and a half ago, and someone saying that this COVID-19 might be a black swan event. And at the time, I said, I'm not sure that this is going to be a black swan event, because I think it's something that's going to happen slowly over a period of time. But, I clearly was wrong on that, right? So, this is non-farm payroll. As you can see, this chart goes back to 2008. We've clearly blown that out of the water in terms of changes in payroll. And this is where I think fiscal policy is really going to step in and hopefully dampen some of the effects of this, because if we really had this type of job loss without a stimulus package, things could get really, really ugly. So the fact that the U.S. government and governments around the world have reacted relatively quickly to help offset this is really what I think has brought the stability back into the markets. It's crazy to see this type of number in the markets, and the markets, stay up about 6% yesterday after we had this type of number. And this chart here on the right, which is unemployment claims, 3.3 million, this chart goes back 50 years. Notice how the peak of this over the last 50 years was the 87 crash, about 690,000 claims. Last week, we had 3.3 million. We've also, not only have we never seen anything of this magnitude, we've never seen anything of this speed either. Unemployment claims usually builds up, over the course of a year or so. Here, we've had it over in just a few weeks. And that's given that context, I think the market sell-off, as nasty and as violent as that has been, reflects what really is happening in our economy, and this type of damage is massive to our economy, and it's important that we understand that. So looking at the coronavirus, this is something we've been tracking very heavily over the last few days. I do have some good news. That first trend that we started to see on Tuesday, which I was showing you, that we were starting to see perhaps a peak in the number of deaths in terms of Italy after shutting down for roughly a little over 2 weeks or so. That trend is starting to continue lower. We had a small spike up here on Wednesday, but looks like as of right now, that peak is still standing. And that's a good sign, meaning countries going into lockdown is effective in terms of being able to slow down the growth of the coronavirus. This is the United States trend that is still clearly growing. And Laura brought up a really good point the other day that, before, what we were doing is we were tracking tests or a number of new cases, and that's heavily dependent on how many tests that country has. And, in the United States, we certainly did not have enough tests in the early days. So what we started doing is tracking the number of deaths, which, regardless of how many tests you have, this is the trend that I think is a little bit more consistent. It's still trending in the same direction as tests, but Laura brought up a good point, and we switched to looking at the number of deaths to help us track whether or not we've reached that peak. So hopefully, with this type of data, we're looking at, hopefully, the United States tracks about a week and a half behind Italy, because we did lock down really not until March 18th, March 20th here in New York, which is where 50% of the cases in the United States are. So, we are tracking New York and across the globe fairly heavily right now. And for those of you that want to look at the Johns Hopkins coronavirus resources, this is a link that we've also sent out. I will post this into the chat window for those of you that want to see this. But what we're really looking for is a chart that looks like this as it increases and it starts to taper off. So far, China has exhibited that, and also South Korea has exhibited that. South Korea has done a phenomenal job at being able to contain this, and really, I think, is a template for other countries to follow. But, in the US, we're still in that exponential point of that curve. What we're really looking for is for that to taper off. Italy, this is the data I just showed you. There was still an increase yesterday, but that's still below the peak of 6.6 number of new cases per day. Spain is a close second behind US and Italy right now. So these are the countries that we're tracking, and pretty much most countries right now are following in the same footsteps as US and Italy. So if Italy is the country that's starting to taper off, US hopefully is next, Spain and Germany after that. And then if we can see other countries follow that same case, then we have, that would certainly be positive data from our perspective, because bad news is still better than an unknown right now. So unknowns are probably the worst things for the market. Looking at economic impact, this is something I also discussed here last night, just to give everyone a brief understanding. One of the concerns that we have is the fact that now that China has removed some of their lockdown procedures, we want to see how things are doing in terms of getting back on their feet. So if we look at some of the high frequency data that we have access to, it's still nowhere near normal by any means. So most of the data that we're looking at, high frequency data that's not like economic data that will sometimes take weeks or months to see, this is real-time data. Most of the data we're looking at are still about 30 to 40% below normal levels 2 weeks out. So if we follow this type of trend, we're likely projecting out another probably 30 to 60 days before things really get back to normal, meaning we're looking at 90 to 120 days from the lockdown period for a country to get back to normal. The other thing that we're also seeing is that as Chinese factories are coming back online, as they want to get back to work, as they want to start producing goods, the rest of the world is on lockdown. The rest of the world is shut down. So they're not buying these goods. So that's also some of the rocky starts that we'll expect countries like China, Italy, and even us, as we are ahead of the curve, that when we recover and we're ready to get back to work, that not the rest of the world may still be in lockdown and may not be ready to get back to work. And that may extend the length of this economic slowdown. The other way that we're looking at this, the other data point that we're looking at, is more of a bottoms up approach. Now, this approach is very, very tricky, and is there will be a lot of number changes as we kind of go along, because we're really not going to see the impact of US companies in terms of how large they were impacted by this until Q2 earnings, which is really starting in July. So it's really July, August, September, by the time we truly understand the economic impact of this. And it won't be until 2021 when we really get a sense for whether or not we've recovered. So the numbers that we're currently looking at is a decline of S&P earnings data from about $176 a share down to about $138 a share. So that's about a 20% decline in earnings for the S&P 500. We're down roughly about 20% from that. So if you apply the same multiple, you could say that we are somewhat fairly valued, but I don't think that you could just apply the same multiple that we were trading at the end of at the beginning of 2020, which is roughly 22 times earnings. So there has to be some multiple contraction here. But those are the ways that we're trying to answer the question, where are we? Are we fairly valued at this point? Are we overvalued, undervalued? There's a few different ways that we can answer this, but those are the data points that we're trying to look at to help answer that question. And lastly, one of the things that we've been tracking very heavily to help you guys better understand where you should focus your attention on is really liquidity. Now, I will say liquidity certainly is improving, but it's still far from normal. Liquidity, when we spoke last Friday, there was about 55 liquid symbols that we would trade at that time. Normally that lists about 300 to 400. So 55 is certainly a very, very short list. When we spoke on Tuesday, that number increased to about 88. And looking at yesterday's closing data, that number has increased to about 102. So I've created this link for everyone. It's a very simple spreadsheet that just gives you symbol and the liquidity. And as you can see, we have about 57 very liquid symbols and about 102 total, liquid and somewhat liquid symbols. So if you want to trade options, you generally want to, at this point, stick to these very liquid symbols. If you want to venture into these somewhat liquid symbols, you can, but I would generally try to stay out of this I would generally try to stay out of symbols outside of these two lists, because anything outside of these two lists right now, bid-ask spreads are still very, very wide, and we're tracking bid-ask spreads during the market so that, we're hopefully getting the most accurate data here. And we've been doing this for about a month now. And normally, like I said, it's about 300 to 400 names, but now, we're really down to about 102 names, which is a lot better. It's double than what we had last Friday. So things are improving, but nowhere near the normality. So this liquidity is looking at monthly options, but generally speaking, weekly options and monthly options will not differ in terms of liquidity. So monthly options versus weekly options, they're just as liquid. So if something's on the very liquid name, you could really trade both monthly or weekly options as well. So, that's where we currently stand. I will point out to a few different names that I'm currently paying attention to. One name that I'm looking at is Boeing. Boeing's had a significant move to the upside. We're almost about 100% move to the upside. Looks like pre-market, it's about to open up a little bit. And I think this is going to be the general theme we're going to see here today, which is we've had a 20% rally in 2 days. Likely you're going to see some check back. You're going to see some movement to the downside. Even if you expect markets to move higher, what I think you should do is try to wait for a little bit of a pullback to get long here in this market, because and see if whether or not these levels will hold. So if we look at SPY, 260, 270 is the level that I'm really keeping an eye out for. 284 is the level above that I'm keeping an eye out for. I expect a ton of resistance at those types of levels. I will say that my views on being bearish on this market has changed a little bit over the last few days. Our daily play trades are still heavily short. I'm inclined to hold on to them because, and maybe I'm a little biased living in New York, seeing what's happening here in New York that maybe the rest of the country is not experiencing, but things are really bad here in in New York. We're on complete lockdown, and, listening to the stories that we hear out of the hospitals here are pretty dire. So perhaps my views are a little skewed and maybe a little biased, and I just want to be upfront for you as far as what my views are in terms of the markets. But there are still a lot of unknowns as to what this is going to look like, what the economic impact is going to look like. I don't think just a 20% decline in the markets prices in what we're about to experience. That's my view. You might have different views, but that's why I'm looking at more bearish trades at this moment, especially as markets rally 20%. I'm looking for opportunities to potentially look at some stocks that I think are maybe a little, have rallied a little bit too much. I'm not saying Boeing is in that category, but if you look at Boeing, one of the things is that it just reached its 20-day moving average at about 180. Looks like it's about to bounce lower. It's down about $10 pre-market here. So again, I expect that even if you expect markets to continue moving higher, that you at least anticipate that there's going to be a small check back, because markets don't just rally 100% and keep going. After rallying 100%, they're likely going to pull back, pause for a little bit before they continue moving forward. So that's the theme that I expect in the markets today. And we'll see next week as to whether this is going to be just a rally, a bear market rally, and we're going to head lower, or we're going to get some more support here. If we do get more support, if stocks fall a little bit and start breaking above their 20-day moving average, then I would probably shift my views longer term and say, I'm no longer as bearish on the markets, and I'm going to flip myself to being more neutral. So that's my view and how I'm looking at the markets. I hope that this was useful in helping you guys understand where to look, because I think you're going to see a lot of big name stocks that are in similar cases like Boeing, McDonald's. A very large stock in our economy, one of the largest stocks in the consumer discretionary space, down roughly 50%, rallied almost 30% here. I expect to see at least a small decline here before perhaps a recovery. But, from my perspective, McDonald's, I think, is going to have a tough time in the next few quarters, as restaurants will really struggle to stay open over the next few months. And, my views are that, I think at best it's fairly valued right now. But I think that things could get potentially worse. So I hope this was useful. I have a few minutes to try to answer some questions, or if you have any symbols you want me to take a look at. Jacques, I don't currently have a liquidity list for the TSX, but that's something that we may be able to publish soon. So thank you for that feedback, and I will get back to you on that. If you don't mind, also send me an email at info@optionsplay.com, and I'm happy to take a look at that. So I have a question here from Jim to look at Amazon. Amazon has held up significantly well. I do think that Amazon, out of all of this will come out a winner compared to Target and Walmart, simply because, you know, they have the more extensive experience for shopping online versus Target and Walmart. You know, deliveries are obviously preferable in this current market environment than having to go out to your store and buy materials. Amazon also at the same time has a big portion of their revenue from Amazon Web Services, which puts them again significantly better positioned than Walmart or Target. So I think Amazon's a winner here as a result of the coronavirus. Hard to say how much higher they can go here in this particular market, because I do think consumer spending is going to take a huge hit over the next few quarters here. So, you know, I'm more neutral on Amazon, but I'm certainly not bearish here. TLT, Jan wants to take a look at TLT. TLT, you know, has really been in this range bound between 165 and 160 or so. If we get a break above that 165 level and pre-market looks like we're up a little, you know, I do think that we're going to continue to see a demand for safe haven, so treasury bonds. So TLT, I certainly think, will be one of the names that will benefit from that flight to safety, if you will. Can you look at a CGC, Canopy Growth? So, you know, marijuana stocks have certainly sort of recovered a little bit here, but if you look at the overall trend, it does not look pretty at all. You know, you might get a short-term rally up to that $17 level, but you really have to get back above 17 for me to say that perhaps there's a bottom here on cannabis stocks. I'm generally speaking not very bullish on this industry right now. I don't think federal legalization is on the table anytime soon. Canada, the numbers out of Canada are not particularly spectacular. You know, growth certainly is there, but there's just too many producers, in my opinion. Apple, you know, is down quite a bit in pre-market, 251. So, you know, this is the type of action that I expect to see over the next, let's just say the next few days at this point, where every time a stock rallies, it's going to see, you know, it's going to be met with some resistance and selling. So when Apple is up, you know, 5% yesterday, you're going to get another check back here today. Hopefully we continue to crawl our way back higher here. You know, I certainly want us to crawl our way back higher because, you know, this certainly does have the hallmarks of what you would normally consider a bottoming formation, almost like an inverted head and shoulders, declining volume as you go from right shoulder to left shoulder to right shoulder. You know, this is generally speaking the type of formation that we're looking at for a bottom. So I certainly hope that we don't see another wave selling, because I think that's going to be terrible for a lot of portfolios. Lastly, let's just take a look at a few things. Given the poor liquidity and the wide spreads for LEAPs, what's the best approach to get into them? The best approach is to try to put your orders in at the midpoint. I would, you know, I pretty much, you know, any options trade that I've been making, I only place orders at the midpoint. I've also stuck to only trading these names. I will not trade anything outside of these names, because you will likely not get filled at the midpoint. But when I'm trading these names and I put my orders at the midpoint, I'm getting filled pretty quickly. So I haven't had a lot of execution problems, but that's partially because I've stuck to the very liquid names, and I've always put my orders at the midpoint. I never go even a penny above the midpoint on any of these trades, and I haven't had any issues getting filled. So I expect that most people would experience something similar as well. Why the spike in XOM and VLO? So, you know, energy sector, I generally think I would stay away from the energy sector. You know, I think Mike and I discussed this in depth yesterday. So for those of you that want to watch that recording, please do. But it's certainly one of the sectors that I would stay away. I think it was just rallying because the market was rallying, and correlations are extremely high. Correlations are still in the 60-70% right now. So as the markets rally, all assets rally along with it. And maybe that becomes an opportunity to potentially short some of those names if you are inclined to remain bearish on energy. A lot of questions here. Let me see if I can get to some of the ones that I think a lot of people are probably interested in asking. So someone's asking about gold. What are my thoughts about gold? So I certainly think that gold is, going to continue staying high. So I think you're going to see a demand for gold as a hedge potentially for inflation. Something Mike also talked about last night, which with the huge stimulus package, you do have a risk of higher inflation. Gold is generally used as a hedge against inflation. I also think gold miners may be a good sector to take a look at here. It looks like gold miners are down about 3% here pre-market. And what you want to, gold miners stand to benefit from a higher price in gold, and we are certainly seeing an average price, higher price here in gold. I don't see quarterly rebalancing having a huge effect on the markets over the next 3 months, in my opinion, because all assets have sold off. So it's not like fixed income has sold off less per se, so that you have a rebalancing of equities or into fixed income. We're still continuing to see outflows out of equities into fixed income. What's your view on Microsoft and tech in general? So I think tech is certainly going to be one of the sectors that recovers faster than the other sectors. But I think right now with implied correlations so high, you're going to see roughly markets move lockstep with each other. So again, this points back to, you can certainly pick individual stocks, and you is starting to see some winners and some losers, but for the most part, the charts look pretty much the same across the board. I generally find that it's better to trade the ETFs. You have less single stock risk, and I think there's too much single stock risk out there right now. There's just, unless you're very, very diligent about doing fundamental analysis, looking at balance sheets, there's a lot of risk of picking single stocks right now. I still think it makes more sense to trade, big cap ETFs like SPY, QQQs, especially if you're trading options on them, because those you can get in and out very quickly. And you're not susceptible to the same single stock risk that you have with some other companies, So that's my view still about trying to pick individual names. Zoom, long-term winner to work from home. I certainly, I'm very bullish on Zoom, but I will say, at $141 a share, trading at some pretty crazy multiples right now, it's hard to go long these stocks. Just from a simple valuation perspective, I think if you're going to go long, you better go long on a very short-term momentum basis. That's my view. Car rental, I really don't have much of a view here on Hertz or any of those names. I anticipate, again, consumer demand to be fairly low, in the next few months. So I'm not as bullish on car rentals. I don't see a lot of people jumping out there to go to rent cars anytime soon. Hopefully I'm wrong. I really do. I really hope that we all get back on our feet sooner than later. I certainly don't want to be cooped up in my house for the next 3 months. I'm sure many of you feel the same way. So, again, that goes back to we all of us doing our part in helping contain the spread of this virus. And hopefully we'll all get back on our feet sooner than later. That's really what I'm hoping for right now. So I hope that this was, again, useful for everyone here today. I hope that you guys were able to catch my fairly long discussion with Michael Coe last night. Hopefully we'll be on CNBC tonight. Right now the studios are closed, so we are trying to do CNBC from our homes. We'll see how that works out. There's a lot of news coming out, so things get shifted around a lot. But I hope that we'll be able to be on the show tonight, either on the phone or perhaps on the camera setup that we're starting to set up here at home. Don't know how long we're going to be doing that for, but looking forward to at least being back on TV, giving you guys more ideas. I'll just leave this off by, asking, someone's asking about utilities. Utilities is certainly one of the sectors that I would pay attention to. It is down, about 2.7% pre-market, but, utilities is yielding a fair amount of yield right now. And that's really, I think, where you want to focus your attention on is more yield, because I don't think you're going to see a lot of capital appreciation over the next few months. But if you can generate 4 or 5% yield while the markets move sideways, that's where I would focus my attention on. You're not going to get that from the fixed income markets right now. But within investment grade, as the Fed is going to support that market, within utilities, within the only high yielding sector that I would generally stay away from right now is energy. But utilities certainly, I think, is worth taking a look at. So thank you so much. I hope you guys stay safe, stay at home, and I will see you guys on Tuesday. Have a great day.